dear students, to the massive open online course on money and financial markets. In today's module, we are going to deal with the Keynesian liquidity preference theory. The main objective of this module are as follows. We will learn about the Keynesian concept of the demand for money. What are the motives of individuals for holding money? What are the different motives? On what factors they depend on? And then we are going to learn about what is the concept of the liquidity trap. Now, in the money market, equilibrium is achieved when demand for money is equal to the supply of money. There is no problem with the concept of the supply of money because the supply of money is determined by the central bank, and so it is exogenously fixed. Keynes, in his liquidity preference theory, states the relationship between the interest rate, liquidity preferences, and the supply of money. He explains the preference for money or liquidity and the reason to demand and get a high interest rate for long-term financial assets. And this theory would like to explain people's motive to prefer holding cash rather than investing in interest-bearing securities. We can say that the liquidity preference theory of interest is a theory of money that explains the monetary nature of the interest rate. Keynes had explained that liquidity preference influences the interest rate rather than the savings decision. And he believed that money or liquidity is necessary for economic activity in monetary production economies compared to savings. The individual decides the portion for spending and reserve for future consumption based on his level of income. Also, factors like psychology, uncertainty about the future, and the economic structure, these also influences the portion of spending by the consumers. So when it comes to saving for the future, people can hold money in the form of cash or investment in interest-bearing assets. Now, if the demand for cash balance is behavior towards risk, both demand for cash balances and the interest rate will manifest in an inverse relationship. And if the interest rate is low, people will prefer holding cash and vice versa. So also people prefer a high interest rate for long-term securities compared to low interest rate for short-term securities. It also points to the fact that the interest rate is a price for parting with liquidity. So whenever the individuals wants to part with liquidity, they want a price for that, and that price basically is the interest, or parting with their desire to hold wealth in the form of cash. Now, when we come to the concept of the demand for money as has been propounded by Keynes, according to Keynes, there are basically three motives for holding money. He calls them the transactions motive, the precautionary motive, and the speculative motive. In the transactions motive, we all know that to carry on transaction during a stipulated period of time, an individual must hold a part of his income in the form of cash, for his day-to-day transaction purposes. He will need cash in his hand. Every time he cannot go to the bank, or he cannot go and he cannot sell his bonds or anything to do something. So he needs cash in his hand. So the amount that is held for these transaction purposes is basically called the transactions demand for money, or in other words, it is also called the transaction balance. And we can very well understand that this depends on the individual's level of income. So if I call this transaction demand for money as LT, then this LT basically is a function of Y, where Y represents his income. So LT, so we can say that as Y rises, that is as income rises, an individual is going to have more demand for this transaction motive for holding money. So it will be a positive function. So change in LT due to change in Y should be greater than 0. So here LT represents the transactions balance. Coming to the second one, it is called the precautionary motive. What is precautionary motive? This motive arises from the desire of the individual to hold some amount of money for unforeseen events or for contingency purposes. Now, we know that in the context of an individual, he might need money for certain medical emergencies or for certain repair bills or for certain contingencies. So he will have to keep some money aside. And this again also depends on the level of income. So when his level of income rises, his precautionary demand for money is also going to rise, and so we can say that this also depends positively on the level of income. So here if we denote the precautionary demand for money as LP, here LP also is positively related to Y, and these two demand for money, which we call the transaction and the precautionary demand for money, both of them depend on the level of income, and we can call both of them together as idle balances. We can call them as demand for idle balances. Keynes puts together the transactions demand for money and the precautionary demand for money and calls it the demand for active balances. Demand for active balances, which he denotes as L1. So what is L1? L1 is basically LT, which is a transactions demand for money, which is which is positively related to Y, that is income, plus LP, which is a precautionary demand for money, which is again positively related to income. So L1 is equal to LT plus LP, and both of them are positively related to Y, and this together what Keynes call is the demand for active balances. Next we come to the third demand for money. This third demand for money is called the speculative demand for money. What do we basically mean by this speculative demand for money? It is the amount of cash money that is held for speculative purposes. So it's cash that is held by the consumer, but he is keeping this for speculation or for speculative purposes. And in this context, before I can explain this, we need to understand one thing, that what is the relationship between price of bonds and the rate of interest. Now assume that there is a normal rate of interest R that is prevailing in the economy. If the actual or the market rate of interest is very low, people will expect the rate of interest to go up in the future. So if they expect the interest rate to go up in the future, the price of bonds will essentially fall. So if the individuals are holding bonds, they will suffer a capital loss, and so they will hold more cash and less bonds. This can be explained with the help of this diagram. In this diagram you can see a curve, and we can also see the interest rate on the vertical axis and the speculative demand for money on the horizontal axis. We see that at very extreme interest rates, that is, suppose it is a very high interest rate or a very low interest rate, there will be general consensus amongst the investors about their future course of action. If I take the very high interest rate, as you can see in the figure, it is RH. RH denotes a very high interest rate. So here every investor will rush for bonds, as they will expect the interest rate to fall in future. So everyone will rush for bonds, and with the increase in bonds in the hands of the investors, the interest rate will go down. Now if the interest rate is lower, so as the interest rate will rise in future, lowering bond price, many investors would again find money to be their preferred asset. So this is basically the liquidity preference schedule Keynes calls this the liquidity preference schedule, where we see that there is a relationship between the interest rate and the demand for money, basically the speculative demand for money. At a very low interest rate, almost all investors would expect the interest to rise substantially in the future. At this rate, there is a general expectation of capital loss on the bonds that will outweigh the interest earnings. So, after reaching this very low interest rate, which is referred to as R3 in this diagram, we find that the speculative demand for money will increase infinitely and no one is basically going to hold bonds. So, there will be no further drop in the interest rate after here, and Keynes basically terms this situation as the liquidity trap situation, and the speculative demand for money schedule becomes nearly horizontal in this zone. So, this is a zone of the liquidity trap. In between the two extremes of the interest rates, the demand for speculative balances will vary inversely with the rate of interest. So, thus we have the demand for money, which is basically one portion of the demand for money, which is basically depending on the level of income, which we call L1, which is a combination of the transactions demand for money and the precautionary demand for money, which depends on the level of income positively. And the other is the speculative demand for money, which depends on the rate of interest and not on income, and it depends on it negatively. So, if we have an overall demand function, the Keynesian demand function for money, it will be called L, which is a function of Y and R. With Y, it is positively related, and with the rate of interest, it is negatively related. Now, we will understand this liquidity trap region. So, if we try to express, as you can see in this slide, if we try to express the money demand function which was a function of Y and R as an equation, we can, as you can see in the slide, it is MD, which is equal to C0 plus C1Y minus C2R, where C1 is positive and C2 is positive. What do I mean by this? The parameter C1 here gives the increase, the parameter C1 here gives the increase in money demand per unit increase in income, and C2 here gives the amount by which money demand declines per unit increase in the interest rate. So, here I have shown both the things. I have shown the functional form of money demand function as also the equation form of the money demand function. So, if I look at the transaction and the precautionary demand, we can say that income rather than interest rate primarily influences the transaction and the precautionary motive, that is, they are relatively interested inelastic. So, they do not depend on the interest rate, so they are interest inelastic. Therefore, as income increases, cash reserve for the transaction and the precautionary motives increase and vice versa. On the other hand, if I look at the speculative motive, it is basically interest elastic because it depends on the interest rate. So, hence the speculative motive and the cash available can help to satisfy the speculative motive in determining the rate of interest. We are now going to show how to draw a liquidity preference schedule in the graph. Now, we have the vertical axis where we are representing it with the rate of interest, and on the horizontal axis we have all types of demand for money. We have the transactions demand, the speculative demand, the precautionary demand, everything. Now, as I have already told you that L1 is basically the combination of both transaction and the precautionary demand for money, while L2 is a speculative demand for money. So, we have both L1 and L2 on the horizontal axis, and only the rate of interest, mind you, and not income on the vertical axis. Now, when we start our analysis in this way. We say that suppose for a particular level of income Y0 in the economy, for a particular level of income Y0, what will be L1? L1 is basically LT plus LP. I am repeating this. So, L1 will be fixed. So, suppose it is this green line as shown in the diagram, green vertical line L1, which is a function of y0. Now, the L2 curve, which is a speculative demand for money, which depends inversely on the interest rate, it is basically shown as this red colored line. Now, what is this? We know that it has got 3 segments. Basically, it has got a vertical segment which coincides with the vertical axis, that is a rate of interest axis. It has got a horizontal segment which I have already referred to as the liquidity trap region, which is the horizontal segment, and then we have the intermediate range, which is a negatively sloped line. So, we have this red colored line which represents L2 or the speculative demand for money depending on the rate of interest. Now, the overall Keynesian demand for money will be given by this L1 plus L2. So, that means the overall L1 plus L2, which I can refer to as a total demand for money, or L, is represented by this yellow line in this diagram, which is the initial part of the L1 line, which was equivalent to the vertical segment of the liquidity preference schedule on the vertical axis. So, L1 plus the L2 part, that is a slope portion, the downward sloping portion of the speculative demand curve, and then again it coincides with the horizontal segment of the liquidity trap. So, this yellow colored line that you see in the diagram is basically the liquidity preference schedule. So, once we get the liquidity preference schedule or the demand for money schedule, and we also, as I have already said at the very beginning, that the supply of money is exogenously fixed in the economy by the RBI or the central bank of the economy. So, here the money supply is denoted by a vertical straight line. So, and we now draw the money demand function. As I have already explained, the money demand function will be initially will have a vertical segment, then it will have a downward sloping segment, and then it will have the liquidity trap segment or the horizontal segment. So, where these two curves intersect, that is basically the equilibrium where the demand for money and the supply for money intersects. We get the equilibrium rate of interest for the economy, which we call it as R star. If the rate of interest is higher than R star, suppose say R1, then we can say that at R1 we can see that the money supply is greater than money demand. So, given the demand for active balances L1, more money will be available for speculative balance in the economy. And so, bond demand, and hence price of bond will rise or the rate of interest will fall till the economy reaches the equilibrium rate of interest R star. Again, when R star is, when the rate of interest is below R star, the opposite situation is going to take place, and thus at the end of the day in the money market, the demand for money should be equal to the supply of money at the given equilibrium rate of interest R star. At the end of the module, let us now focus on the limitations of this liquidity preference theory. We find here that little or no focus has been given to the presence of exogenous elements like uncertainty, which is a very important element in today's life, but in this theory we do not get any reference to it. It overlooks the presence of banks and bank money. Neglecting the bank money causes the theory to minimize the capacity of the monetary authorities to influence the interest rates. Wealth also is an exogenous element whose presence is not explained by this theory. And of course, the assumption of a constant employment rate is not very right. The explanation also specifies either holding as cash or invest in bonds or securities, but both acts in real life can be performed simultaneously. This theory does not take this into account.